All right, let's get started. Good evening, everyone. My name is Jason Reminick. I am the CEO and founder of Thalamus. Want to welcome you tonight to our first ever and Gear Up for Residency with Thalamus webinar series. We're very excited about this initiative and wanting to connect more with applicants and provide them resources which we find valuable, some of which I've used personally as a former residency applicant myself. And really excited about the webinar today with Doc2Doc. And we'll make that introduction in just a second to Dr. Zwade Marshall. But additionally, tonight is 6 Ways You're Wasting Money by someone who's been there. I'm really excited for this webinar as well, and really excited overall for this series. For those of you, most on this call should know us, but at Thalamus, we are a residency interview management platform that most of you likely used, and that's why you're here this evening. But to get to know a bit more about our team, we were founded in 2013. We're celebrating our 10th anniversary, and we're built by GME for GME, and we're a grassroots collaboration of academic physicians and medical researchers, including current and former applicants, program directors, program coordinators, and others in GME. Our team also includes, obviously, software engineers, product experts, and several others involved in the residency selection and transition to residency space. We are a very mission-driven organization. Our mission is to ensure that the right doctor ends up at the right hospital to treat the right patients. We're very focused on social impact, close gaps of access for all, and increase diversity in medicine, including having recently converted to what's called a public benefit corporation back in February. And we do a lot of industry-leading research with regards to the transition to residency, including how geography impacts the match, and several other projects as well, including studies on the physician workforce in the state of California and otherwise. That's our team over the right. Last year was the one on the brick wall above. This past 2 weeks ago, we were in Austin for our company All Hands, and our team continues to grow as we grow alongside the AAMC collaboration as well. And we're really excited to just be out and talking to applicants and providing additional resources, as I've mentioned. And I also wanted to bring up Thalamus.org, which is our sister organization, and that is a 501c3 nonprofit that provides financial assistance in the forms of grants and scholarships to medical students who are underrepresented in medicine, navigating the transition to residency. We've provided over $40,000 in scholarships to 10 medical students over the last season, and have partnered with AMSA as well as the A to Z scholarship. And this is another initiative that we're super excited about. That's several members of our team at the AAMC's Learn Serve Lead conference last November in Seattle as well. And so what we're here tonight is for the first part of a 4-part webinar series that we're testing out now for the first time, which we call Gear Up for Residency with Thalamus. It will be four webinars over a 3-ish week time period. The first is tonight with Doc2Doc. Then next we have physician loans, which will cover physician mortgages on Wednesday, May 22nd. Then we have Practice Link, which is a physician recruitment job board and career advice, and just really awesome company as well. We'll be here June 6th to talk about your future roles beyond training. And then last but not least, we have Doctors Without Borders on Sunday, June 9th. All of the sessions will be recorded, but for each one that you do attend live, you'll gain entry into a drawing where we'll pick one lucky winner to have their residency application fees reimbursed by Thalamus. You can register through the email that you got to register for this. There are some social media links as well, or at Eventbrite at the link below there as well. So really excited for the series. Overall, we want to provide more and more resources to applicants. These are companies that we've known for several years in one capacity or another. Some of them are resources that I've used personally as well, and others on our team and friends and colleagues as well. And they're all very much aligned with what we're trying to accomplish, which is making this transition easier for doctors into training as well. And that really brings us to tonight. And so this is something I'm really excited to present and introduce Dr. Zwade Marshall, who's an MD MBA and the CEO of Doc2Doc Lending. So Thalamus was created following my experience of applying to residency back in 2012 when I got stuck in New York City during Hurricane Sandy and many of my interviews were canceled. And along the way, throughout that season, Zwade and I met on the interview trail. And so it's kind of quite surreal a decade later that we've both started very mission-focused companies to help medical students, residents, fellows, and others navigate this transition into their career. And so, yeah, I don't think you can get more mission aligned than that, and that we've met 10 years ago and kind of, one of the many overlapping points now here. So I'll turn it over to Zwade. I'm really excited for the webinar. We'll open it up to questions at the end. If you have any questions, please put them in the chat or the Q&A. And overall, just really excited. So Zwade, glad to have you here. Excited for the talk, and take it away. You're muted.
Thank you. Fantastic. Thank you, Jason. Let me load my slides and ensure everyone can see them and get in presentation mode. Fantastic. Jason, thanks for the warm introduction. It is certainly my pleasure to be here with you, and it is indeed surreal. For those of you out there, good evening, and welcome to the inaugural webinar for Thalamus. It is really interesting and cool that the relationships that you make over the course of your journey through medicine, whether it's medical school, the interview trail, residency, and beyond, are really become a part of a community of folks that are like-minded and mission-driven. And so hang on to those bonds. Now, this talk is meant to calm some of the fears and anxieties associated with transitioning from medical school to residency. So welcome to the employed class, and congrats on matching if you're getting on this milestone. And I also want to ensure that I give a special shout out to Thalamus for the work they're doing to ensure that they put the financial literacy needs of you guys at the forefront of your minds. Again, I'm Dr. Zwade Marshall. I'm CEO of Doc2Doc Lending, and we're thrilled to offer guidance, tips, tricks of how to manage private and credit card debt as you're transitioning from medical school to residency. I'll speak for about 15 minutes or so, and then I'll leave some room for you guys to ask questions, whether in the chat or audibly. We hope this is interactive and is here for your benefit. On the screen is a QR code to my contact card. So should you have questions that you don't want to share publicly, please do reach out via the card, and we're happy to kind of navigate that with you as well. Now, I'll say quickly that I only have 2 licenses, one to drive a car and one to practice medicine. This is not meant to be financial advisor or as a financial advisor. So just know that I've been in your shoes as Jason has been, and we curated this talk as a part of our experiences based upon what we now know about the marketplace in our roles as leaders of companies that interact with doctors and with the markets. My brief story, I went to medical school at Emory, did college, medical school, and business school there, and graduated out of med school and got into Harvard for my residency. I was going from a low cost of living city in Atlanta to move to Boston for my anesthesia residency at Harvard. And I have a single parent household, had $220,000 in student loan debt, a FICO score that was considered to be subprime. It was less than 680. And my income as a resident was $13.12 an hour. You call it $54,000 a year and 80-hour work weeks, as you all know. And so when I applied for the $17,000 that I needed to go from Atlanta to Boston, I was really surprised to recognize that the banks viewed me as a high-risk borrower, and they either denied my loan application or they gave me a credit card rate. And it just felt really unfair. Most of us as a collective at this time in our transition have relatively poor credit, not because of bad behavior or lack of discipline, but because of an immature credit profile, maybe a delinquency or 2 in paying bills while you were in medical school or college. We've got this large debt from student loans, and we've really got no idea what to expect when we apply for a loan. What is a good credit score? What's a good free cash flow? What's a good debt to income ratio? We don't know these things. So a part of my mission was to help others understand what's involved. And I'm using the experience of having now funded over $106 million in loans to students like you guys in the personal space, transitioning from medical school to residency. And that's over 3,500 borrowers. So I'll talk more specifically about the 6 ways to build wealth faster and to manage that debt that you're going to have as you're needing to access capital or borrow money over the course of your career. One of the biggest things that I think we're not aware of is the importance of increasing your credit score. And the biggest, easiest piece of advice would be for you to immediately get a free credit monitoring service. There's myfico.com, there's freecreditscore.com that'll alert you every time your credit report changes. And the first thing you'll be doing, though, is ensuring that there are no mistakes on there. You won't believe how many times borrowers come to us, and at the time they get their credit checked, because we only do a soft pull, no hard impact. That's the first time that they'll recognize that they've had that cell phone bill from college that they thought they paid off at $70 in a collections account, and it's dragging their FICO score down. The other thing that's really important is having a longer credit history. So let's say you've got 2 credit cards with a limit of $5,000 each, so $10,000 in credit allowed to you, and both cards are maxed. So you're using $10,000 of the credit allowed. Your credit utilization score would be considered to be 100%, and that's not good from a lender perspective. Now, let's say you paid off one of the cards, and you got 5K from your parents, and you paid off one card, and when you paid it off, you closed the account because you want to get out of debt. Now you've got $5,000 of allowed credit from the card that's still open, and that card is still maxed at 5,000. So your credit utilization remains at 100%. If you'd paid off that first card and kept it open and not used the credit card, your credit utilization score goes down to 50%. And that's significantly better for your overall credit score. So keep that in mind. That's the low usage really matters. And then on-time payments matter, making sure that you're not having skipped or missed payments. And while you're in residency, it's really hard to keep up with bills. Consider doing an auto pay as much as you can. It's hard to figure out a budget when you're not making a whole lot of money. And we have some tools in our it's called a TTR toolkit, and you'll have access to that link at the end of the talk that shows what are some of the most common expenses that residents have during the course of that transition, but also during the course of residency. So what is the average resident spending on eating out, on subscription, on car payments and gas and just a relocation expense? And if you can be disciplined and treat budgeting for your transition like you do your studies, you'll be way ahead of the curve here and be more prepared to handle the distractions of money while you're in the training programs. You got to prioritize a few things as you focus on credit and wealth. And we call it an acronym that's DIRE, D-I-R-E. So debt reduction is one. And I mentioned credit card debt being the most common thing that you can make a difference about while you're in training. Your student loans are less of an issue now, but you should be top of mind because you can do what's called an income-based repayment program. And I'll defer to the student loan experts on exactly how to handle loans because that's not a simple solution since everyone's situation is different. And you want to optimize your chances for student loan forgiveness as well. And so there's very nuanced things to do around your loans. This talk is not about that. Debt in this context, it's consumer debt. It's credit cards, it's personal loans, it's car loans, it's all the things that are not considered to be student loans. You also need to contemplate insurance. So malpractice and life insurance are often offered by the GME offices within your residency program. Become familiar with what the limits are on your life insurance policy, especially. And then as you begin to advance through residency, disability insurance becomes very critical because you want to protect your family and your income should you become hurt while in training or while in practice. Retirement savings. The person that begins to save diligently and consistently at the age of 25 will have twice the amount of savings in a retirement account as the person who begins to save at the age 35. So early start, consistency is more important than how much. If you're going to aim for a number, aim for 15% of your income to put aside into your retirement plan if you can afford to do so. Anything helps though. We're often stretched in residency, and that's a part of why we're having this talk. So don't feel terrible if you can't give 15%, but get into the habit of doing something for your retirement planning. And then, of course, it's emergency funds. Having about 3 months worth of your expenses off of salary set aside in a pretty liquid account that you can access should that emergency happen and you need to cover expenses. Automation is going to be your friend, particularly as you begin to take a drink off of that fire hydrant called residency, right? Like it's going to be a lot of stuff coming at you. It's really hard to keep up with which payments the 22nd of the month, which one's on the 13th, how to avoid having these late fees and missed payments impact your overall credit profile. You'll often get a discount on your loans if you're enrolled in auto pay programs. And so think about doing it. Now, the budget is also critically important to guide how much you're going to be adding to your auto pay so that you'll know that you can afford to make those payments on a monthly cadence. And then the part about saving, auto savings is also important. What I did when I was in residency was paid myself first. I had my budget, and whatever I was going to set aside came out off of the top of my paycheck. So I never even saw that money to spend. And then the rest kind of fell in place afterwards. And then finally, that free credit monitoring program that I recommended at the very beginning should be automated to give you at least a quarterly update on what your credit profile is doing. So you'll really see. I think one important point that I did not yet make about credit checks, there's no more ominous thing happening in the credit markets right now, and AI contributes to this than fraud. So with the advent of artificial intelligence and the innovation around it, the fraudsters are actually really benefiting here. And so you want to protect yourself from identity theft and not having accounts opened up in your name with your profile that you have no idea about. And then using free resources within your residency program, your GME office and your HR benefits department will often have discounts on cell phones. There'll be free laundry services at times. There's matches for your 401k plan. Be sure to familiarize yourself with the benefits program within your hospital system. And if you're agnostic or you don't care about which cell phone carrier you're going to have, you can pick the one that gives you the best discount within your hospital system. And also, credit cards and lenders will have incentives as well. 6 months of 0% APR for balance transfers. There'll also be points and cashback rewards programs, Amazon discounts, etc., that you should become very familiar with as you choose which lenders to use. And then mentors like Jason and me, use the folks that you trust that have gone through this path before you and lean on them for advice. There's no better provider than the person recommended by someone that you trust. And so use that network because we're all kind of very, very familiar with the stress associated with transition. And I think your mentors will understand why you need their help at this time. And then there are a lot of AI tools in the good sense that'll help to like scour your credit profile, scour your bank account, and help you find ways in which to save money and subscription fees that you may have forgotten that you're always paying every month. And it kind of saves your time. A few that we've used in the past within our ecosystem, it's Wally, Honeydew, Minsip for ongoing budget tracking as well. And then last, borrowing. So this is the part that you need to be very careful about. If you can afford to go through this process without borrowing money, you should. It's always better to not have to take a loan if you don't need the loan. Should you need the loan, however, you need to be extremely careful and do a comparative analysis of several items associated with borrowing. Most of us will automatically focus on the interest rate, and we don't know what an APR means. And APR is the annualized percentage rate, which is inclusive of interest and all fees associated with the loan. Then think about the actual term of the loan. How many months or years do you have to pay it off? The longer the term, the lower the monthly payment. And for many of us, the monthly payments are of critical importance to us. Beware of loans that offer you an interest-only payment or no payments for some extended period of time, because that may increase the compounded amount of money you have to pay in the future. So if you can afford to begin to make principal and interest payments at the very beginning of the loan, it saves you cash in the long term. But again, sometimes you can't afford to make those principal interest payments and you'll need to pay interest only. So just be aware of all the levers with which you need to be comparing the variables for a loan assessment. And then credit card debt is not the same kind of debt as consumer loans or personal loans. Credit cards are revolving debt, and a balance on a credit card hurts your overall credit profile in a way that an installment loan, like a personal loan, does not. And so if you paid off a credit card with a personal loan and made those on-time payments with that personal loan, only use the card for emergencies and try to pay that balance down at the end of the month down to zero, keeping the account open. That'll help to nurture your credit profile overall. And then finally, consider consolidating all your loans, meaning getting a larger loan to put all the smaller ones together if the interest rates are lower. I'll warn all of you that right now is not the time to consolidate personal loans because rates are an all-time high over the course of the last 5 years. So again, because of the interest rate environment, it's best to avoid borrowing if you don't need to. If you do need to, consider going with companies that understand your career arc and create the features in their loan programs to be helpful for who you are. Finally, we have at Doc2Doc Lending, we have a couple of giveaways for you guys for the matched students, the ones that are transitioning right now, and you'll be able to see more about match day giveaways and our budget planning tools at the QR code on the right. The one on the left is a joint platform, Doc2Doc and Thalamus, that offers you a chance to compare loans, including a Doc2Doc loan should you need it. About the average borrowing amount for students transitioning from medical school to residency is right around $15,000. Depending upon where you're going, though, it could be less, it could be more. And again, we'll help you figure out how much you need to borrow, and you only borrow what you need for that moment. And if you need to come back later, later is actually better because the hope is that rates get lower in the future. But we're here to serve whatever we can. I'll take a breath and open the floor for you all to ask questions. Unless, Jason, you want to react to anything I shared.
Yeah, no, I appreciate it. And you've made these mistakes. I made all of these mistakes myself as well. And I'd say we're both pretty financially literate. And so I think it's really important to those that are on the call to just know that, yeah, you make these mistakes. You also make these mistakes because you get really, really, really busy when you're in residency, and the world doesn't really understand what working 80 to 100 hours a week looks like. And so I think that's why, as I've gone through this, my friends, colleagues, those who are in training with me or otherwise, we try to look for resources within our network who understand what it means to be a practicing physician, to be in training, to be in residency, to be in fellowship. And yeah, that's why we're talking about loans later on as well. That's why we're talking about jobs. That's why we're talking about physician mortgages as well, because a lot of people will say, well, how do I buy a home? And if you have several $100,000 in medical school debt, a traditional mortgage loan does not work because of the debt to revenue ratio, debt to income ratio, sorry. And similarly, like, yeah, Zwade's team knows just what it's like to be a physician because many of them are physicians. And so we want to be here as a resource. It looks like there's one question in the Q&A, but please feel free to drop questions in the chat. If you're brave enough, you're welcome to get on cam or on mic, voice, etc., whatever you're comfortable with. But yeah, Zwade, to just kick it off. The first question that came in was from Pia, and I hope I'm pronouncing that correctly. But for those of us who've had late payments in the past, how can we improve this on our credit and still appear as reliable to lenders?
Great question. I think all past sins are forgiven over time. So start making on-time payments on your lending obligations. And you may be penalized in the immediate term if your late payments have impacted your credit score. But the more on-time payments you have and the more distance that comes between those late payments and the current day scenario, the better off you'll be. So every time you've made on-time payments on a loan, and it's reported to the credit bureaus, it actually helps to improve your credit score. There's some lenders that will that have a floor, meaning their FICO floor, the lowest FICO score that they'll lend to, oftentimes for personal loans, somewhere around 700. At Doc2Doc, we lend it down to 600 as the lowest FICO score because we understand that in our community, we would have those late payments and delinquencies at times. And it's just a matter of the stress of being in medical school and having a really stressful work-life balance that we don't keep up with our bills sometimes. And the point of this is to help to educate you on what matters so you don't make those mistakes again.
Yeah, I think it's really important, and there are a lot of just good tools with banks. I use Chase and Discover personally, and they give me my credit score every month as well. And you'd be amazed at how much even just your credit utilization can affect your overall score, and how you can really get yourself a really nice swing by bringing that utilization down. And then if you get the utilization down, you can at times try to increase the credit limit, and that also changes the calculus by changing the denominator, which gives you more utilization. So it's not medical school, it's not rocket science, but these little things can certainly help you for sure. So great question. The next is from Crystal. Can you walk us through the pay yourself first strategy you mentioned prior, please?
Sure. So I think of it as if I'm going to be making $4,000 per month in gross, let's call it net income after taxes. So your employer will take out the tax part, you get 4,000 into your checking account every month. I will then allocate some amount of money that goes into my savings account immediately. But I'll have my employer, rather than send me $4,000 into my account, send me 3,500 into my checking account that covers my operating expenses, my day-to-day life, and 500 gets routed directly to a separate account for my savings. So I don't actually ever see the money on a monthly basis that I want to save based upon my savings goals. So I'll set the budget at the very beginning. I'll know what my expenses are. I'll have a little bit of a buffer for unexpected incidentals, but I also want to ensure that the savings goal is automatically done at the top, so I never see that money and it just continues to accumulate over time. Great question.
Yeah, I was muted. Sorry. So, yeah, great question and great answer. Next one's a little bit related. It's, what do you feel was the biggest factor to your financial stability being the main provider as a parent in residency? Oh, and Aviva is also a parent. So,
Yeah, that's a great question. I think it's a challenge. For me and for my co-founder, that was probably one of the biggest hardships. It's the amount of money that you make in residency, the time involved in being a resident, and the expenses that come with having kids and a family. It's just a really challenging time. And so what changed the matrix for me was having the ability to moonlight. And so I was very into getting additional shifts to augment my income. In the earliest days, though, it was a lot of family support, a lot of being very frugal and thoughtful about my expenses, and trying to find other ways to do consulting. Jason and I both have MBAs, and so I've always had some other stream of income while in training to augment my residency salary. But I think one of the things that we don't do well as a community is discuss financial hardship together. We'll talk about a tough call. We'll talk about the emotional impact of having lost a patient. We'll commiserate over shelf exams and board exams, but everyone's quiet about money, and we suffer in silence. And I'm telling you that we've had over 8,500 applicants to our platform for loans, and we call each borrower that comes through our platform from groups like Thalamus directly. So you get a call from some doctor in our team, and the stories are incredible. Stories of true hardship, of empathy, and it resonates with all of us because we've felt it too. Now, I don't want to make residency seem doom and gloom. You're gonna have a phenomenal time with the learning, and it's gotten a lot more humane in terms of work hours, and their pay increases annually for every year you advance. That's helpful, but it's going to be challenging. And if you're aware up front and you prepare for it, you'll do very well.
yeah, it's a great question, a great answer. And I have children. I have a child now. I did not when I was a resident, and so can only imagine the financial challenges of that as well. I think, as Zwade kind of alluded to, just having that budget, having that financial plan can at least give you the data that you need to make decisions. You only have so many levers as a resident. And yes, you can moonlight, and that increases your income. You can have various side gigs, be involved with startups, surveys. There's lots of different ways, I think, to get involved as a physician these days, many of which didn't really even exist 10 years ago. But at the same time, you're balancing then family time, and you're balancing clinical time, and you're balancing just kind of wellness time as well. And so it's important to overall, I think, just find that balance. There are the increases in the PGY salary over the years. Some residency programs will provide relocation expense coverage. Some will provide housing stipends. I went to residency in one of the most expensive areas in the country, in the Bay Area in California. Some of these things did exist. We were paid a little bit more, but that increase in salary was offset by the cost of living at the same time. So it's a constant just analysis of where you are, what your financial goals are, and what your life goals are, and trying to balance all of that while being a resident. Not an easy task. Everyone does it. But yeah, as Zwade said, I think we really need to do better as just a community, not only on the financial piece, but also just in the emotional piece of being a resident, what that means too, and the effects that has on us as people, and that we are humans at the end of the day, but certainly finance is a big piece of that as well. So great question. Next is from Zane. What is your advice for international medical graduates transitioning into U.S. residency regarding financing and credit scores?
Yeah, great question. There's no doubt that it's significantly harder for international medical graduates to access money in the US. A number of programs, including Doc2Doc, will fund if you are an international grad with an H-1B or an O-1 visa. So those two categories will treat it like you're a permanent resident. J1s are a little more challenging unless you have a waiver, and that could be an offline discussion. But the other thing would be using a credit union within your hospital system that's aware of your job contract. They can be very friendly advocates for you as an IMG as well. But if it's an O1, H1B, you're eligible with us and with a few others. If you're not any of those two, it's a lot harder.
Yeah, a similar question from Victor is, would you recommend getting new credit cards to take advantage of cash back and travel rewards if doing so hurts your credit score in the short term?
It depends. It's a good question. It depends. If you open a new credit card account, you can anticipate to see a decline in your credit score initially. However, due to the incentives offered by many card holders now, where it's 0% APR for the first 6 or 12 months, there are a lot of cash rewards. There are a good number of online tools that help you compare cards, the rewards from those cards, so you can do a side-by-side comparison and weigh that against your cash need, and then make the decision. So it's not an easy answer. It depends upon your financial situation, what your current credit score is, and what you need the capital to do.
Yeah, to piggyback off of that too, I think everything's about balance also. So if there is a card that you're looking at with an incentive that you really need, and it's going to, not affect your credit score too much, that may be enticing. I wouldn't go on a spree to open up a Southwest card and a Marriott card and a this card and a that card so that you can go on a trip or all of these things, because then you're just potentially racking up debt and/or cards or accounts that you're not going to use and/or accounts that are going to close too. And so just be cognizant of what you're doing. The cost benefit there is having a good credit score is going to wash all of those, is going to be a better pro in your life than any of the pros that you'll probably get through most of the incentives and rewards, especially if you need to do things like lease a car or you're planning to buy a house, because that will impact your overall interest rate as well. So everything's about budget and everyone's own personal situation, but these are just some things to think about as you're approaching that. Next question is from Rodrigo. How do you recommend creating a budget? In other words, how should one determine monthly caps for each category?
Yeah, that's a really personalized process and depends upon what state you're in, cost of living, and where you are. Our budget tool at the link will be helpful for you there. We'll ask a couple of questions. You get to kind of put in your information, but think of it as, look, as you get settled into your new environment and as you forecast what your rent would be, if you're moving for a July 1st start, you should have some sense now of where you're going to be living with housing costs. within your GME office and your residency office and the chief residence of where you're going to, there are going to be some community type resources around helping you forecast what costs will be in that environment. Doing some of that research, reaching out to future mentors, can help give you a sense of kind of a baseline. And then over the course of the subsequent 3 months after you start, you'll be able to adjust accordingly.
Yeah, I'd really lean on resources from the program. I think another just great resource that may not be as apparent is the program coordinator / program administrator, usually almost a parent figure to most of the residents that they take care of in the residency programs that they run, and have seen people come in and out of their programs over time, and usually have some really great resources as well if you're shy to approach other residents, and you shouldn't be, or your attendings or otherwise as well. But there's just an ample amount of knowledge and resources within your program that should be really helpful for you to leverage, especially if you're not from the area or the state where you're going to do training. The next question is connected from Angela. Is there a tool to estimate net income ahead of time based on state?
Doximity has a couple of really good tools pertaining to this. And the accuracy, it's not very, very granular because your net income depends upon your tax bracket, your dependents and the like. So net, for those of you that don't know, gross income is the total amount of money that you're being paid. Net income is the money that you get after taxes are withheld, Medicare, insurance, etc. And so it's tough to get that to precision ahead of time, but there are tools from Doximity especially that is done by state and by region within state that could be helpful there.
Yeah, and depending on how ahead of time is ahead of time, you can always speak to the HR, the hospital, program coordinators, et cetera. Obviously, when you receive your first paycheck, you're going to see what those deductions look like from the gross to the net. And so they're just things to consider. I'd also figure out when your first paycheck is. That's not always, depending on how long a oh gosh, what's called the onboarding phase for your residency program is. Sometimes the paycheck doesn't come till a little bit later, so make sure there isn't a gap there, particularly if you're budgeting for expenses and such as well. So these are really stellar questions. These are the only ones that have come in so far. Zwade, I don't know if anything else to add or if anyone has any questions. I believe we still have some time.
No, I think I'll say thank you for the time, guys, and thanks for the thoughtful questions. We're going to be here as a resource. This presentation is going to live evergreen. Jason's team will be reaching out with some resources and tools for you guys that you'll be able to follow up with us. But this is not the end of the conversation. We're here to be a resource to you. Thank you, Thalamus. Thank you, Jason, for the platform, and know that we're here to be supportive of your community. Really appreciate the time.
Yeah, no, we're super excited, and thank you, Zwade, so much for joining us to kick off this really important series. Again, I think there was really great engagement, really great questions tonight. Excited for the rest of the series as well. As I mentioned prior, the next session will be this Wednesday, May 22nd at 8 p.m. Eastern, where we'll be joined by the team from Physician Loans to talk about physician mortgages, which are special mortgages that are only available to physicians. And I think is another really great piece, just the overall financial literacy, entering into training and heading towards the future of your career as well. If you enjoyed what you saw, please spread the word to your classmates, your current graduates, your incoming co-residents, et cetera. We want to understand how helpful these resources are. We'll be sending out some surveys as well, just to kind of get your feedback to understand, how can we bring this more to the transition to residency community and provide these helpful resources to help you all start thinking about the important things heading into training as well. And also, please enjoy your time now, personal time with family, travel, or otherwise, especially if you're heading into residency. Do not study, do not unless you have to pass the test or something, but don't focus on that. Focus on life. There will be plenty of time to study medicine over the next several years as well. And so really appreciate everyone tonight with the time. We will send out the recording in some capacity and be in touch. And for those of you who can join us on Wednesday, that would be awesome. Big thank you to Brooke Moore and Sarah Nathan from my team for helping to put this together as well. And we'll see you at the next series. Hope everyone enjoys their Sunday night and the rest of their weekend. And yeah, please follow up with Doc2Doc if you have any questions. And we'll see you at the next one. Thanks, everybody.
Thank you.